inflation, reflation, or something else? That question is the same question that you asked in your very first sentence on a post that you made, Jeff, on January 4th at Alhambra Partners. And I guess, is it a question of semantics, inflation, reflation, or something else? What were you getting at?
Yeah, and I think we need to be clear on our terms, right? Because an inflationary environment, what does that actually mean? A reflationary environment, what does that actually mean? And if it's not inflationary or reflationary, then what's left, right? And so let's start with an inflationary environment. And I think a lot of people think of inflationary environment as, well, consumer prices rise or even accelerate. And that's only the first step. Not only does, it's not about food prices rising or, education and healthcare prices rising. An inflationary environment, first of all, is a broad-based increase in all consumer prices. Think back to the 1970s for people who are old enough to do that, or even if you've read anything about the 1970s and the Great Inflation, it wasn't that food prices went up or something else went up. It was the price of everything goes up, and it goes up a lot. And what separates inflation from reflation really is it doesn't just go up a little bit here and then stop. It goes up and it goes up and it goes up and it goes up and it goes up, and it doesn't stop. It's a sustained, broad-based increase in consumer prices that comes back to us and tells us that we have a monetary imbalance in the opposite direction of what we have now, the opposite direction being too much. There's too much going on. And so an inflationary environment, like we hear a lot about the last couple of months, that's what it would mean. We would see a broad-based, sustained trend in consumer prices, not for a couple months, not for even a couple years, but as a paradigm shift into something else.
And presumably, Jeff, it's not just all bad news. It would come along with rising real wages. Isn't that right?
Rising, well, at least nominal wages.
Nominal.
Yeah, nominal wages would go up, and as we'd expect, employment levels to rise too. The problem in the 70s wasn't that nominal activity was moving forward, is that consumer price advances were basically eating all of that up. So that workers in particular were basically at best standing still. Even though your pay got bigger every year, it cost you more to live and maintain the same lifestyle. So at the best, you were staying the same, even though you got paid a lot more. In a lot of cases, you end up suffering even worse because in certain places, the pay levels and wage increases didn't keep up with the cost of living.
Let's talk about present day. We can measure inflation in a number of ways, and everyone disagrees. Everyone's a critic. But we could turn to markets. We could turn to surveys. We could take polls. How much inflation do you think there will be in the future? You can ask markets. In index-linked bonds, inflation-protected securities. And you were looking at them recently on January 4th, and you saw that what? Inflation was rising, nominal rates were doing what, and what were real rates doing?
In TIPS market, the inflation break-even, which is the real yield that the TIPS, that the market prices in TIPS, compared to the same maturity U.S. Treasury nominal yield, that gives us a measure of what the market is expecting for the CPI to price out on average for the duration of that instrument. So whatever maturity is, if it's a 5-year TIPS instrument, the 5-year inflation break even is basically the market saying, what do we think the CPI is going to average over the next 5 years? And the inflation break evens, which is a measure of inflation expectations related to the CPI, have gone up, and they've gone up significantly over the last couple of months. The 5-year break even and the 10-year break even both broke above 2% recently. And in fact, I think they're up even another 10 or 20 basis points over the couple of weeks since then, since I wrote the article. So what we're seeing is that inflation expectations are rising. And like copper, we talked about before in another podcast, copper's at a multi-year high. We're seeing the same thing in inflation expectations in the TIPS market, at least the break-evens, which are also at a multi-year high, the highest since 2018.
That's right. And I've pulled up a chart right now of the benchmark 10-year nominal U.S. Treasury security and the Treasury inflation protected security to calculate what the expected inflation would be, the real rates. And it's very interesting, Jeff. We see, yes, break-even rising for the first time in a long time after a central bank action. Nominal, not so much, or not as much, right? The slope is not as sharp, meaning that the difference then is that real yields are falling, and precipitously so. Like recently, since November, it's gotten ugly.
Real
What
ugly.
does that mean?
So you have inflation break-evens, the inflation expectation at a multi-year high. At the same time, the real yield is at record lows, not multi-year lows, record lows. We've never seen real yields this low. And so it's not that, hey, we're going into an inflationary acceleration period. What the market is saying is, well, something's driving the CPI, but it's not the real economy that's doing it. It's not the inflationary environment that we'd expect that looks like the 1970s. In fact, I think the answer is exactly what we talked about before with copper, which is the supply side in crude oil. Because as we know very well, WTI, as it flows through gasoline prices, is what drives the CPI more than any single factor out there. And so what the market here is really kind of saying is that this economy isn't getting better. It's not getting inflationary, but oil prices are up, and compared to where they used to be, they're not actually up. They're just down less than they were a couple months ago. But how that works through the CPI is that we get paid by percentage annual increases, and the percentage annual increase in oil is going to look pretty good from where it was a couple months ago. And so as we interpret that into economic terms, what it says is that the economy isn't getting better, and it's going to actually become more miserable as you have to pay more at the pump.
Speaking of paying at the pump, Eric Townsend, Macro Voices, Art Berman on January 7th. The whole show is about oil. So if any of our audience wanted to learn more about that particular market and where it's going, I recommend that show. Jeff, I'm going to ask you about the shorter end, the shorter term yields and what they're telling us. And let me do that first by showing you the nominal yield curve going back to 1991, 2001, January of 2011, and then just right now, January of 2021. So going back 10 years, 4 times, it's amazing. It's amazing. And you can see it's just how much we've fallen. Unbelievable. So, and what the interesting thing is, Jeff, this yield curve in January in each of those decades, we were heading into recession, we were in recession, or we were approaching a crisis. And you can so these are not great occurrences, great moments of economic history, but you can just see how much worse it's getting. If you have anything to offer about that, great.
I think I'm glad you brought this chart up, Emil, and I think it's a really good chart that you put together here because it's exactly what you said. You're comparing to awful times, right? These are yield curves for U.S. heading into recession. These are bad times. This is what a yield curve looks like when you say, oh, crap. These are oh, crap yield curves. And so here we have this inflationary explosion supposedly taking place when it's dare I say, perfectly Japanese. I mean, that, again, getting back to that point, people like to dismiss the Japanese example. Here it is, right for you. I mean, it's right in front of you. It's priced out, and it's indicated in the yield curve, which basically says we have become Japan. Japan was not an outlier; they were just first. They pioneered the wrong trail, and we've all followed along. Not just in terms of how it's resulted, but what the official sector and central banks and governments have done to try to offset these things, and they never lead to inflationary recovery because it's not in the cards. It's not in the curves, I should say. And this is a really good reflection of what is the bond market actually telling us here. And getting back to what we talked about before with inflation expectations is, yes, oil prices are up because supplies have been cut somewhere between 16 and 25%, depending on the location. And so that's not an economic, an economically positive increase in supply. At the same time that I think a lot of speculators are overvaluing the return of demand in the post-vaccine era. And it's not an inflationary environment under the definitions that we presented before, which is broad-based, economic-based, sustained consumer price increases. That's not what the bond market is showing you here. The bond market is basically saying oil prices are up, but the economy isn't.
Let's talk about the shorter term bills, and I think they're sending a similar message to what the long-term real yields are telling us. Maybe it's not as dramatic a decrease, but I perceive that they're falling a little bit. They're certainly not rising. Am I wrong? And is that a concern? Because these are, again, this is the most important form of collateral that you need for liquidity purposes. You would think that if things are getting better, if inflation's coming along and the economy is going to be moving forward, then you would see some lift as opposed to a scramble
Or
for
at
the
least
short
lower
term.
risk, right? A lower risk environment. If things are proceeding towards even just a reflationary environment where things are better, risk is, risk is not so evident and close at hand, so immediate. If we're experiencing a reflationary environment, we would expect bill yields to be at least somewhat higher than they are. But what you see, not just bill yields, but in the short-term Treasury notes, like the 2-year, for example, we've seen that rate fall. It's come back up a little bit over the last couple of days, but it's dropped considerably. And it got down to, all the rest of it got down into mixed up with all the rest of the bills, which tells you for all the stuff that's supposedly going on in the TIPS market and inflation break-evens, why aren't the short-term treasuries doing anything other than rally? Why aren't they reflecting the same things that inflation break-evens are? And I think, as you pointed out, Emil, exactly right. The short end of the yield curve is trading very much like longer real yields are in TIPS, which is that nothing really much has changed here. The current, at least in the short run or in the intermediate term, prospects are not very good. Things are not really proceeding the way they're supposed to. There's a lot of risk remaining.
Well, I hate to end it on such a down note, Jeff. Is there anything positive that you would like to bring up? The Bills making the playoffs, for example.
Not just making the playoffs, but actually winning their division for the first time in 25 years and stomping on the Patriots while they did it. So, I mean, as a Bills fan, as a long-suffering Bills fan, that was an extremely satisfying experience. Hopefully that will continue and go further, but we'll see about that. And it goes to show you that anything can actually happen. So as we examine these marketplaces, yeah, maybe there's in my mind, a very small possibility that we end up in a Weimar Germany hyperinflationary collapse. But hey, you never know. Things can happen.
I'm thinking that the central banks can look to the bills and say, we've been going the wrong way for decades, just like that organization. But there is hope. You can turn around. You just got to put the right people in charge, and it can happen.
That's it. That's it. That's our story for this week. Absolutely.